Okay, so we've discussed crude sensitives already, so I'm not getting into crude sensitives. But metals is where you need to understand that what is the sensitivity impact. While this is the right graphic that if commodities fall, there would be a sentimental rub-off effect in some of the commodity producers. But in commodities, it's always if commodity producers are benefiting, commodity consumers will not be benefiting as long as the demand vertical is strong. So one works with an assumption that look, demand in India is going to be strong. Within producers and the consumers, which way things would move. Because for the first time we've seen what really could be called as a decisive downtick in some of the global commodity prices. Very unusual. It's happening at a time when dollar index is going down, so 2 and 2 is not matching, but data is data. Now you work with an assumption that if metal, steel, aluminum, copper, if they come down, where the sensitivity is highest? Of course the sensitivity would be highest in CVs and passenger vehicles because of the extent of commodity which is used. But the margin sensitivity to 1%, and this is very important, just 1% metal prices, if they come down on a blended basis, it adds up everything you consume. For Maruti, the sensitivity could be as high as 15 bips, Hero 17 bips, Bajaj Auto 15 bips, Eicher 6 bips, TVS and Mahindra all in double digits. So at a time when we are looking at auto companies which are struggling with discounts, could they really get a shot in the arm if commodity prices they remain lower? Because they could be either in a position to give better discounts or they could be in a position to protect margins. Similarly, if you just weave it around, and we don't have that graphic ready yet because vegetable oil prices and other commodity prices have not come down so extensively, so FMCG sensitivity is not there. But I think post crude, where direct beneficiary would be airlines, paint companies, OMCs, now auto companies, could they really get a spring in their stride given that commodity prices are down, and at a time when they're struggling with inventory, could this really help them in terms of boosting their entire proposition in terms of getting margins back? And that is the reason why some of these auto stocks, despite the headlines which are universal and well known now, that inventories are building up, sales are declining, they're not even in 5 and 7 digit for passenger car companies, they're holding on. So if you're wondering that, okay, why auto stocks which should have declined because of demand concerns and early demand indicators are not strong, they've not come down, I think that this really could be the reason that markets expect that metals are down and the margins in a sense would be protected or discounts would not be that steeper.